Hello and welcome to Morning Brief Market Sunrise. I'm Josh Schafer in for Ramzan Karmarli, live from Yahoo Finance's studios in New York. It's Tuesday, July 15th. U.S. futures pointing toward new records for the Nasdaq at the open thanks to shares of Nvidia, which are surging more than 5%. We'll break down why investors are cheering the chipmaker's latest breakthrough in China. And investors keeping a close eye on trade escalations as they await a crucial reading on inflation this morning. Finally, second quarter earnings season is in full swing with some of America's largest financial institutions announcing quarterly results. We'll be breaking those down for you throughout the next half hour as they cross the tape. So grab your coffee and let's own the morning. Let's kick things off with what you need to know before the opening bell rings by taking a look at the futures board. As you can see, a bit of a mixed picture here. Dow Jones Industrial Average Futures up just slightly, but the Nasdaq really leading today with tech leading the charge as investors patiently await that crucial reading on inflation on Tuesday morning, and bank earnings are starting to cross the wires. I also want to flip over to Europe and take a look at the London FTSE. That's above 9,000 or touched above 9,000 earlier in the session for the first time ever. But here in the U.S., it is all about tech. Tech is leading the action here as easing restrictions on Nvidia chip sales to China have sent shares of the AI leader up more than 5% in pre-market trading. Nvidia is set to open at a record high Tuesday morning after a blog post from CEO Jensen Huang said the company will resume sales of its H20 AI chip in China. Nvidia's reignition of H20 chip sales comes just day after Huang's meeting with President Trump. The company had previously said its curbs on H20 sales would cut its revenue by $15 billion. Wedbush Securities analyst Dan Ives called the announcement this morning a, quote, watershed moment for Nvidia, the AI revolution thesis, and the overall U.S. tech industry. The risk on sentiment in markets comes as investors continue to look through the ongoing trade war sparked by President Trump's tariffs. Overnight, Bloomberg reported the European Union has finalized a second list of countermeasures targeting U.S. goods worth roughly $84 billion. But President Trump has stressed negotiations are ongoing ahead of a key August 1st deadline. Trump said Monday that Europe is, quote, coming over. They'd like to talk. In a recent note to clients, Morgan Stanley Chief Investment Officer Mike Wilson had noted that U.S. stocks have remained resilient in recent weeks despite the ongoing tariff back and forth, in part because key trading partners such as China haven't been targeted. And finally, we're watching cryptocurrencies again this morning with the world's largest coin, Bitcoin, paring back some of its gains from yesterday after hitting a record high above 122,000 on Monday. You can see on your screen there, Bitcoin changing hands at about $117,000 per coin as Crypto Week in Washington continues. Yahoo Finance's Josh Lipton sat down with the host of The Wolf of All Street, Scott Melker, to break down what to watch in crypto this week. Let's take a listen.
Crypto Week in Washington, Scott, what are you watching for there? What's on your radar?
Well, we definitely want to see the Genius Act, which has already passed the Senate, get passed easily in the House and end up on President Trump's desk. We know that that's one of his priorities. And getting clarity on stablecoins really is the lowest hanging fruit for legislators right now. And I think it'll give us much more clarity on what companies can do moving forward. Of course, that's going to be followed by a number of other pieces of crypto legislation that really are important and we need to see action on. Namely, for me, is the Clarity Act, which is the market structure bill that we're looking for. That's going to determine what is and is not a security or a commodity. But more importantly, is also going to lay out the rules of the road for exchanges and other operators in the industry. Can an exchange also be a custodian? Well, they really can't in the legacy market, but they still can in the crypto market. These questions need to be answered, and they really need to be answered soon, because it is very likely that we're going to start focusing on midterms and that there could be, a change from red to blue in either the House or the Senate, and then these things could stall. So now is really the time for legislators who are passionate about this industry to strike while the iron's hot.
Scott, you mentioned Trump there. I'm just curious. I mean, you have a president clearly in a White House, an administration that is crypto friendly. What role, if any, do you think they're playing in this rally?
Well, I think that Trump is been very clearly a crypto-forward president, as you said, and you couldn't have more of a 180-degree change from the previous administration. So I definitely think that has been a huge catalyst. If you look around the administration as a whole, even in all of the leading positions that are unrelated to financial markets, you have Bitcoiners literally across the board. It's like a fever dream for those of us who have been in the industry for so long and have dealt with a contentious government. So at every regulator across the board, we have people who deeply believe in Bitcoin because in this case, they probably have similar values to people who would be Bitcoiners and have gone down the rabbit hole. So I think he's played for what is likely to happen for crypto in the country. That said, that also comes with a lot of Trump. So there's a bit of a grift and a bit of controversy that comes with any of that.
Final question, Scott, just to get your take on this. The proliferation of Bitcoin treasury companies, Scott, what do you make of that trend and theme?
Okay, so for me, there's a very important distinction. There's Bitcoin treasury companies, which are companies that financially engineer their balance sheets and their assets and their stock to buy more Bitcoin. To me, that's adding on additional risk and leverage, and I can't quite understand why they're trading at such a premium to the net asset value. There's also Bitcoin balance sheet companies, what I call them, and those are companies that are like Tesla and Square in the last Bitcoin cycle, who simply are taking 5 or 10% of their cash and putting it into Bitcoin as a hedge against inflation and to protect against that cash being devalued. To me, that's a much safer bet. That's how an individual should approach Bitcoin in their portfolio as well. You just want to own some. It has idiosyncratic risk. It behaves differently than other assets, and it's a great hedge. Financially engineering a balance sheet, to me, looks like it's the beginning of the next bubble. I'm not going to say we're at the end of that bubble by any chance. I think we're at the beginning. But I think that at the end of this bull market or this particular rally in a few months, those are going to be the people that are puking up their Bitcoin because they've entered too late or have done poor financial engineering and are forced to sell.
Breaking news, JPMorgan just reporting second quarter earnings. The bank posting adjusting earnings per share of $5.24. That's topping analyst expectations. And revenue coming in at $44.9 billion, also a slight beat compared to expectations. JPMorgan Chairman and CEO Jamie Dimon saying in the press release the U.S. economy remained resilient in the quarter. The finalization of tax reform and potential deregulation are positive for the economic outlook. However, Dimon added, significant risks persist, including from tariffs and trade uncertainty. You saw on your screen there the stock edging higher on the news, and I want to dig a little bit further into some of these numbers. So JPM's net interest income coming in at $23.3 billion. Equity trading and sales revenue came in at $3.25 billion. That was slightly above estimates. Of course, equity trading would involve some of that volatility that we saw within the market and a large amount of trading that we saw in the second quarter amid that tariff turmoil. Then looking at investment banking revenue coming in at $2.68 billion. That was well above the street's estimate of $2.16 billion. Of course, we've seen a bit more M&A starting to pick up in the second quarter. The IPO market also starting to warm up as well. And then getting back to that net interest income story for JPMorgan, full year net interest income now projected to be at $95.5 billion. That is up from estimates of $94.5 billion. JPMorgan have been on a pretty good run headed into this release. Seems like an overall positive report for the large bank, but stock not moving too much. Should note JPMorgan stock had been up 20% year to date coming into this release, 40% over the past year. So perhaps some of the positivity that we're seeing in this release already discounted a little bit within the market. I do want to flip over to another large bank that we're watching this morning that also has earnings out. We're going to take a look at Wells Fargo. So Wells Fargo reporting revenue of $20.82 billion in the second quarter. That is above estimates of $20.74 billion. Earnings per share coming in at $1.60, above estimates of $1.41. But you're seeing on your screen right now, Wells shares down over 1%. I think that's probably most likely because they're missing estimates on net interest income. So net interest income coming in a little bit lower than expected in the quarter. Then you flip to Wells's full year forecast for net interest income. That's at $11.7 billion. That's below the $11.83 billion that Wall Street had expected. Wells Fargo stock had also been acting pretty well this year. Stock was up 18% year to date, 47% over the last year. Broadly, relatively solid results from two large banks as we kick off a key week of earnings season, where we're hearing from a lot of financial companies. We're going to hear from Bank of America tomorrow. BlackRock also out with results earlier this morning. Financials have been one of the strongest sectors amid this rally, with XLF up over 24% over the past year. So we'll be listening closely on the call throughout the morning here to hear what these CEOs have to say about the health of the U.S. economy and the health of the U.S. consumer. Will be particularly interesting to hear how card activity is going at a company like JPMorgan Chase, usually a good read into how Americans might be spending. Well, now it's time for a quick break, but stick around for our trending tickers later in the show and further analysis on the earnings reports coming out today. Welcome back. Before we dive into some tickers that are trending this morning that you need to know about the latest updates on two laggards in the Magnificent Seven. I'm talking about Tesla and Apple. Take a look at this chart. Since the start of the year, while Nvidia is up more than 22%, Tesla is down by roughly the same percentage, and Apple has lost about 16%. So there's a lot going on here, and a lot going on at Tesla, but there's one headline that caught our attention. Tesla just opened its first showroom in India. Its Mumbai store is called a, quote, experience center, and it marks a milestone for Elon Musk after years of diplomatic negotiations and setbacks in one of the world's largest countries. While some individuals in India have been able to buy Teslas through private channels, today marks the first day Tesla is officially selling cars in the subcontinent. Now shareholders are managing expectations, and here's one reason why: tariffs. Tesla cars won't be produced in India, at least not for now, and imported vehicles will face tariffs of at least 70%. Yes, 70%. Setting the minimum price for a Model Y at around $70,000, and that's a high price in a country where per capita output is much lower than elsewhere. Not to mention competition with much cheaper Chinese and Indian brands of electric vehicles. So we'll keep an eye on sales in India and keep bringing you updates. Now on to Apple. Corey Johnson from Atrocity Capital Research shared his views on Apple's artificial intelligence struggles with our very own Josh Lipton on Asking for a Trend.
One of the things about acquiring an AI company right now, we certainly see it from the headlines from, in particular, Mark Zuckerberg taking over hiring at Meta, is that the assets walk out the door every day. You might have a great large language model all cooked up, but the ability to evolve upon that is really those hard to come by AI engineers. And those engineers getting offers, which are kind of hard to believe, but 100 million, 200 million, Juan Soto kind of numbers, those may be true, those may be related to weird compensation involving stock options and over time. But I think that the notion that you would go out and buy a company and own the assets isn't what really happens here. What happens is the assets are sitting in a chair and can take the elevator out and be gone the next day. So it's a trickier thing in this era as this industry evolves. And I think that that's the point. Right, is that Apple has never been first to the game. You could argue maybe back in the 70s when they invented some of the first personal computers, then they were first to the game. But Apple has typically not been first to the game in the products that they release. They wait for the pioneers to take the arrows, and then they create just a better product. And we've seen that time and again from Apple.
How would you generally characterize, Corey, Apple's AI approach, Apple's AI strategy, and how you see it differing than a lot of the other tech giants we talk so much about?
Well, I think it's really important that it follows a lot of the things that they do from a product basis, whether it's software or hardware, that they are very focused on user privacy, and they're very focused with the things happening on the device, which is how they make their money, is selling devices. Yes, services are an increasing component of their revenue. But I think that going forward, what we're going to see from Apple is they're going to start to incorporate pieces of AI into these devices. They're not willing to have the problems that OpenAI, that ChatGPT is given with hallucinations or Claude or Gemini. They want to have a higher quality product. I think they've been burned by some of the errors we've seen from Siri, and yet the Siri errors are nowhere near as bad as the results that have come out of ChatGPT or Gemini or even Claude over the course of the last couple of years. And I think that what they want to have are some in-app or on-device AI processing that's happening, and the chips are just getting there. And what that's going to mean is a real big turnover in phones that won't be able to do things that the most of the phones in the market, the new phones in the market will be able to do. And it's going to create some real sort of device envy among their users with the new iPhones coming out this fall, and indeed the phones coming out next year and the year after that. They're going to start to look really different. They're actually going to physically look very different. We're going to have a foldable iPhone as well. But the notion that you can do certain things in AI with a newer iPhone that you can't with an old iPhone could really create a new driver of demand for their physical devices.
And that was Corey Johnson's view there. We'll be back with trending tickers just after a short break. Stay with us. It's now time for some trending tickers, and our first stock we're taking a look at today is set for a very strong start when the bell rings on Wall Street. The trade desk surged nearly 15% in pre-market trading after the announcement that the advertising company is set to join the S&P 500. S&P Global said the trade desk, or ticker symbol TTD, will replace engineering software company Ansys starting this Friday. Ansys is being acquired by chip designer Synopsys in a $35 billion deal. The trade desk has a roughly $37 billion market cap, and it was founded in 2009 by Jeff Green and David Pickles before going public on the NASDAQ in 2016. The California-based digital advertising platform offers omni-channel campaigns and a one-stop shop for marketing, brand, and sales campaigns. Just keep in mind, though, while it's pretty common for a stock to rally as it goes into the S&P 500 index, as a lot of index investors sort of pile into those stocks, Trade Desk does operate in a very competitive space in some of the areas, with its competitors including giants like Google and Amazon in that advertising space. Now we're moving on to the British-Australian mining company Rio Tinto. This ticker is trading on the London market, and it's been in the spotlight this morning because Rio Tinto has named a new CEO, Simon Trott, who is currently the CEO of Iron Ore, a major driver of profits for the mining conglomerate. He used to be Rio Tinto's chief commercial officer. He will take over as CEO in late August. He'll be replacing Jacob Stausholm at the top of the mothership. Stausholm, who had been CEO since 2020, oversaw the company's big bet on lithium and expansions in copper and other commodities. Despite the big change in leadership, we aren't seeing major swings in this stock, but keep an eye out on it as more details about strategy and outlook are likely to follow. And finally, our third ticker. It's a big one and one of the best performing stocks in the world this year, Palantir. Palantir roughly flat this morning after closing roughly 5% higher yesterday. Dan Ives over at Wedbush told Yahoo Finance that he expects this stock to outperform and even said he is, quote, seeing $1 trillion company in the next 2 or 3 years. Now that would require staggering growth for the company, which has a market cap of around $350 billion. Palantir provides data analytics and technologies in a range of sectors and is seen as a key player in AI. Year to date, its stock has basically doubled in value, now up more than 97%. And speaking of AI companies that are flying in the stock market, Meta up more than 20% this year. One factor that's getting investors excited, Mark Zuckerberg's massive plans for artificial intelligence, which include a data center that's almost as big as Manhattan. Our Yahoo Finance tech editor, Dan Howley, explains.
These are some big moves that Meta is undertaking. Two of the data centers that they discussed, one was Prometheus. That's a 1 gigawatt data center. The other is going to be upwards of 5 gigawatts. So just to give you an example, a gigawatt is a billion watts. The estimate is that can run up to 800,000 homes over the course of a year. So the amount of power that these are pulling is absolutely incredible. And part of the effort here is to build up Meta's superintelligence lab. And the thinking is to develop an AI that kind of exceeds human intelligence. They're also obviously using these to train their own AIs, their Llama AIs, and then that being used in their advertising efforts, as well as their recommendation engine efforts. And so this is all part of the kind of long-term Meta strategy as they push forward into AI. And it's worth pointing out that in addition to those kind of capabilities, the AI will also be used as part of Meta's push into the kind of augmented reality space where they have, augmented reality glasses and things of that nature. So it's going to encompass all of its products, but this build out is just going to be absolutely incredible. I mean, one of the size of one of the labs kind of takes up a large portion of Manhattan when overlaid on it. So just to give you an example, I mean, that's the size of the Hyperion is the second data center that they're working on, and so that's how large it's going to be. So it'll be interesting to see, when these are fully built, what they have to offer, what the impact will be of these. Obviously, they're huge, resource-intensive data centers, and so we'll just have to see where this kind of leads for Meta.
Dan, obviously Meta, as you know, this has a lot of fans on the street, right? And those bulls will often, Dan, they'll make the argument that this is a company where AI investments are paying off, and they'll point to user time and advertiser spend. And I'm just interested in what you make of that argument.
Yeah, I mean, look, it makes sense, right? For Meta, they've specifically pointed towards how their advertising customers are using their AI offerings when it comes to building out, smaller parts of ad campaigns, things like that, to make it easier for the smaller advertisers, the smaller customers to get their products out there. And that's really the backbone of Meta. It's the small advertisers, not the massive companies, but the smaller companies that really make up the bulk of its advertising revenue. And so getting those kinds of technologies and capabilities out there so they can get their products out there will eventually help them, and has helped them so far. And then as far as you pointed to longer user time, I mean, they're seeing that with the recommendations engines that they've kind of helped to build up, and Reels obviously pulling more people in. So it seems to be working. This seems to be the kind of poster child for where the AI investments start to pay off. We're obviously seeing it in Google and Amazon and Microsoft as well, although they're more focused, Microsoft, on the enterprise side of things. They do have advertising, but when it comes to Meta, it's really that advertising, that user kind of dwell time that really is getting kind of the play and showing that this is starting to pay off.
Going to be interesting to watch what happens with Meta. They're, of course, one of the largest stocks in the market that has been driving this broader tech rally. And that's really what we're seeing this morning, right? I want to take a look at how markets are moving right now. You can see NASDAQ futures up over 0.6%. Again, a tech-led rally that we've been watching on Wall Street really for, it feels like, 2 years now, but certainly recently, specifically this morning. We were just talking about earlier, Nvidia shares up almost 5% this morning. Their H20 chip is going to be sold again in China. That is a key catalyst for this stock, and really a key catalyst for this market as a whole. The latest leg higher for the S&P 500 to these consistent record highs has, of course, followed Nvidia record highs. You can see that stock looking like it's going to open above $170 a share today. That would be its highest level ever. And we're also going to be keeping an eye on the fallout from big bank earnings. JPMorgan shares were up slightly earlier, now down a little bit. Wells Fargo shares down about 2%. Those conference calls going to be taking place around 8:30 this morning. We'll be covering that later on Morning Brief with some key takeaways from that. But also in focus, of course, on this Tuesday morning is going to be the Consumer Price Index report expected at 8:30. Going to be key to see how prices are increasing or decreasing, or maybe less than expected in that month of June. But that's going to do it for us today on Market Sunrise. Stay with Yahoo Finance at 8:30 a.m. Eastern. Julie Hyman will have live breaking coverage of the June CPI report. I'm Josh Schafer. Go on the morning.